It's not just you. Student credit cards are almost always terrible, and they're not getting any better.
Often students are carrying a balance, and with interest rates topping 20%.
Americans are borrowing more than ever. U.S. household debt now at $17.94 trillion. For credit cards, that debt has never cost more. The average interest rate almost 22%.
They promise to help you build credit, but behind lies a devastating trap. But how did we get here? Let's rewind to the 1950s. The first modern credit card, Diners Club, was invented to let customers dine in without carrying any cash. Soon after, banks like Bank of America launched their own cards, what we now call Visa and MasterCard. Originally, credit cards were a convenient alternative to checks. They weren't tailored to students at all. But as education costs ballooned, banks discovered a gold mine in young adults, especially those that they knew wouldn't have the financial know-how to fight back. Today, the credit card industry is a trillion-dollar machine. And guess who they've set their sights on? College students. The very group you'd think our system would protect. The banks realized if they could hook you early, they'd profit off interest charges for decades. They offer student-friendly cards with low credit limits but sky-high APR for the first few months. It's brilliant for them, devastating for you if you're not careful. From cringe TV commercials to YouTubers pushing build your credit, no problem.
This video, we're gonna go over what I think are the 6 best credit cards.
Applying for your first credit card can...
If you're a college student looking for a new credit card, then
these 5 credit cards.
The marketing is everywhere. Today's student credit cards are designed with hidden fees, surprise rate hikes, and penalty APRs that shoot up to 30% or more. An absolute windfall for banks and a nightmare for you. You miss one payment and you're stuck paying off interest for years. And it only takes one slip up. That's exactly what they're banking on. Quite literally. This is where it really gets interesting. Let's break down the biggest pitfalls and how you can avoid them, because student credit cards aren't just a way to build credit. They can become a financial black hole if you're not careful. Banks and credit card companies often lure students in with bright promises. No annual fee, 0% APR if you qualify, and bonus points for textbooks. But here's the truth. These so-called perks are designed to make you spend more and keep spending. But the least shocking thing about this system is that it works.
Now, what I mainly looked for in these cards was that they had no annual fees.
A good sign-up bonus, 2, no annual fee.
look at 7 cards that offer benefits like no annual fees, solid cash back.
You get money back in the form of cash back when you spend your money on everyday purchases.
The FED recently announced that for the first time in history, the US credit card debt surpassed $1 trillion with a T. The credit card industry's cash cow is the user who revolves a balance. But what does that really mean? When you revolve a balance, you're carrying leftover debt from month to month instead of paying it off in full. You might see a minimum payment of, say, $25 on a $500 balance, so you think that's manageable. But here's the catch. Any unpaid portion of your balance starts accruing interest, often at punishingly high rates. This is exactly what credit card companies bank on, because students with limited cash flow are more likely to revolve, and that means steady interest payments straight into the bank's pocket. Imagine you're juggling part-time jobs, tuition, and a social life. You open a student credit card just to have that safety net, an emergency fund. It starts off fine until it doesn't. Meet Emily. Emily was a freshman with a modest part-time job. She got a student credit card with a low intro APR and a $1,000 limit, as close to free money as you can get as a student. Books, weekend outings, pizza deliveries, it added up pretty fast. By month 4, she was at her $1,000 limit. The intro rate ended, her APR jumped to 24%, and she could only afford the minimum payment. Over a few more months, missed due dates led to a penalty APR of nearly 30%. One unexpected car repair later, she was drowning in interest and late fees. Emily's situation isn't unique. A 2023 study found that 43% of college students carry over $1,000 in credit card debt at any given time, often on multiple credit cards. Let's break down exactly why this happens. Limited income. Most students work part-time or rely on financial aid, meaning less disposable cash to pay off full statements. That makes them prime candidates to revolve a balance. Marketing tactics. From campus booths to targeted online ads, student-specific credit cards often promise freebies like t-shirts, sign-up bonuses, or cash back on coffee, but they rarely highlight how swiftly interest can grow if you don't pay in full. Lack of financial education. Let's face it, many of us aren't taught about interest rates or credit utilization in high school. So we learn the hard way in college, when banks are all too happy to profit from our inexperience. But it's not just the marketing or the lack of income. There's a bigger, systemic reason student credit cards are so profitable and so risky. Credit card companies thrive on what's called the revolving door of debt. They know that if you pay off your balance in full every month, they make almost nothing off of you. Where they really cash in is on interest and fees, especially from customers who are late or consistently carry a balance. Because students are new to credit, they're more likely to slip up or overspend. One small mistake, like forgetting a due date, can trigger fees and a penalty APR that lasts for months. Multiply that out by millions of student cardholders, and you've got a multi-billion-dollar industry built on our slip-ups. You might assume colleges would protect students from financial pitfalls, but in reality, some universities and credit card companies are in bed together, profiting off your debt before you even graduate. In fact, major banks have struck exclusive deals with schools to market directly on campus. In some cases, universities receive hefty kickbacks or revenue sharing benefits for every new card open. They sell campus mailing lists or grant special access to student orientations. Meanwhile, the cards themselves come loaded with high interest rates and hidden fees, a perfect trap for inexperienced cardholders. And here's the kicker. While schools preach financial responsibility, they're often profiting from the very cards that drown students in debt. When you sign up, your university might get paid, yet you're the one footing the bill in the form of 20 to 30% APR rates and crushing late fees. You might be wondering, don't laws protect students from predatory practices on campus? Enter the Card Act of 2009. It was supposed to crack down on credit card companies wooing young adults with freebies and sky-high interest rates. And while it did stop some of the worst offenders, like handing out pizza for signups right on the quad, banks found their workarounds. Here's the catch. The Card Act only goes so far. Sure, it closed some old loopholes, but it opened some new ones. Now, instead of handing out water bottles on campus, banks strike exclusive deals with universities behind the scenes, getting access to student email lists or orientation events without even setting foot on campus. Or they target you online where the law can't fully reach. In theory, the Card Act tried to protect students' wallets. In practice, it's more of a band-aid. The law clamps down on traditional campus tabling, but banks still thrive through digital marketing and official school partnerships. But what happens when you're no longer a student? You might think you'll just graduate and leave that credit card debt behind, but the reality is much, much harsher. One study found that among adults who declared bankruptcy by age 30, over 50% say their debt problems started with the student-targeted credit card. That's right, more than half of young bankruptcies trace back to those harmless campus credit cards. The financial stress you rack up during college doesn't magically disappear after graduation. For many, it snowballs. Late fees and penalty APRs morph into damaged credit scores, making it tough to rent an apartment, secure a car loan, or even pass certain job background checks. Your life becomes more expensive, and eventually your income can't keep up. That student-targeted card became a ball and chain, dragging you deeper into debt at a time when you're supposed to be laying the foundation for your future. Graduation should be a moment of opportunity. New career, new goals, maybe even a new city. But with thousands of dollars in lingering high interest debt, some graduates find themselves stuck in survival mode, unable to save or invest. And when emergencies hit, like medical bills or job loss, bankruptcy can feel like the only escape. But the most shocking point, which all of you missed, is that this is my first YouTube video. So a simple like, subscribe, and comment would mean more to me than you can imagine.